GenLife out with its March quarter update with funds under management increasing some 40%. The company also reporting $100 million in inflows for the first time. To discuss it, let's bring in Grant Hackett, GenLife Chief Executive and, incidentally, in case you didn't realise, Olympic swimming legend. Grant, couldn't help that. Hey, great to talk to you this morning.
Thank you for having me.
All right, so this is obviously important milestones that you met within the company. Just talk us through how you got there.
Absolutely. Well, I've been, with the group for almost 4 years now, and just a few years ago, when we look back on FY17, we were doing $131 million in sales for the total year in the investment bond space. Fast forward, a few years later, we're now doing that in almost just a quarter. So the journey and the trajectory of the company has been very, very positive. We did $332 million worth of sales last year in FY20, and I think we'll certainly exceed that in FY21, particularly coming off such a great result in the third quarter. And our half-year results were very good. We were 26% up on revenue, 45% up on NPAT over the prior corresponding period. So very pleasing to have this sort of momentum at the moment with so much uncertainty still around us.
Well, yes, your funds under management chart is quite impressive. So what's the sales pitch to bring these new funds on board? What are you offering?
So with the investment bond structure, the best way we compare the actual product is really against superannuation, because superannuation is the product that we know and love. That's the after-tax paying structure. An investment bond is exactly the same as that, but there's no preservation age and it has a maximum tax rate of 30%. So naturally for an investor, we're investment agnostic. We have a whole heap of funds that sit within the investment menu across 50 different options, every single asset class with multiple options within each. And obviously, if you're a high-paying tax individual, this is a great structure to be able to invest through, but know that you've got full liquidity of your funds, unlike superannuation. So we've been out there, particularly since the changes in 2017 with the caps in superannuation, really presenting, I guess, the new innovative investment bond. We recut the investment menu, we lowered the pricing, put new product features around, particularly around our estate planning, which is a very attractive product for that particular aspect as well, and the fact that you have tax-free transfers. So we collectively got together as a team and we really made a hard run at this, and it's certainly transferred into results, and we've continued to see that year in, year out again. And also we restructured the team here to really put a real focus on the sales and marketing side of the business as well.
And Grant, you talk about your diversity. Are you any concerns there of risks perhaps ahead, particularly, I guess, with the prospect of inflation? How are you playing that?
So we feel very confident that we're in a good position regardless of which way markets turn. And the reason I can say that with confidence is because last year when we went into March, we were all sort of concerned about where the market was going to end up. We saw those sharp market contractions in March of 2020. And we ended up going into Q4. We obviously did our full financial profile of what the business could stand in such extreme conditions. And funnily enough, our outflows went down and our inflows went up. And I think that's because there's more to this than just the investment performance. Obviously, like I said, there's a tax arbitrage, but given that we were going into a pandemic and there's a lot of estate planning features that you can apply with the investment bond structure, and I won't bore you with the detail of that now, we actually saw that people came to this structure to be able to look at their overall asset position and formulate this as part of their sort of holistic planning for their estate planning. We certainly saw the need for that go up. In terms of the outlook moving forward, like I said, we feel very, very positive. Obviously, inflation is an issue on everybody's mind at the moment. We're wondering where interest rates will go eventually. We're seeing more positive, economic activity, and right now we're seeing the benefits of that as a business.
So in terms of funds coming in, we've settled on that. Now you're saying you're giving tax-effective quarterly distributions. Do you have some sort of return on equity here, like you're giving out 3, 4, 5? I mean, anything's better than zero, right? But do you have some sort of target?
Absolutely. So we've got multiple products, and then the product that you're referring to there is our new tax-effective equity income fund, which we launched to the wholesale market, and mid-next month we're about to launch to the retail market. So effectively what that is, that's a partnership with Martin Currie, the team there, the Legg Mason Martin Currie Fund, which has now been absorbed, of course, by Franklin Templeton, who bought Legg Mason probably 6 or 7 months ago. And we teamed up with them, and that's an equity income fund with tax-effective distributions that sit sub 10%, and that's compared to an individual's on 47%. That's the tax rate that they'll receive because of the investment bond tax structure. And the average yield you're looking at that for the income side of it, so not the capital growth, is at about 6.4, 6.5% today. So it's pretty competitive when we're in this low yield environment. People are looking around, what risk do I need to take on to get yields that I was used to a few years ago, whether it was with term deposits or fixed interest products. Now they've got to go up on that risk curve to produce the same sort of yield. And what we've done as an organisation is really looked at, well, how can we generate what we call the tax alpha? So lowering the overall tax rate to be able to increase the overall yield, but not obviously increase the investment risk at the same time. And we feel like we've really achieved that with this new product that we recently launched in Q3.
One thing we've been talking about the industry in general is just when people need advice more than ever, the actual financial services industry is shrinking rapidly. Like, I'm sorry, there's a whole bunch of us who want more than a sexy app. So what are you doing to add to the financial services industry as well?
So more broadly speaking, the one thing that's really challenging at the moment is the fact that we're seeing financial advisors contract. If I look at us, selfishly as a business, we receive over 90% of our inflows through financial advisors when they're giving their advice to their underlying clients. But it's a matter of how we actually making that advice accessible, particularly to the baby boomer population, which is now retiring, the mums and dads of Australia that really need financial advice. They've got longevity risk on one side, which we're developing an annuity product around at the moment. And of course, we've got sequency risk where we don't know where markets are going to sharply contract. And I think we're all well aware of that since we saw the impact that COVID had, particularly in March of last year. So we're really out there trying to advocate in the financial services space, advocate that people do need advice. In Australia in particular, we talk a lot about robo-advice overseas and how well that's worked in the US, but I think culturally, and this is just a personal point of view, I think people in Australia, mums and dads of Australia, like to see the whites of people's eyes, and that if they're going to receive financial advice for all the money that they've saved up over a working lifetime, they want to feel like they can trust that individual, they want to feel like they can work with that individual. But on the other side of that, just the risk and compliance and the burden that the financial advisor has now, and the cost to be able to service every single individual client is so expensive. It's very, very difficult for them to be able to manage a client who's got less than $500,000 worth of investable assets. And we'd like to see that change over time, and obviously improve for financial advisors and making sure that all Australians are getting access to the right financial advice and structuring to ensure they have a great retirement.
It's a great point you make there, Grant. Hey, thanks so much for joining us from GenLife.
No worries. Thanks for your time. Have a great day. Cheers.